Hello and welcome to Data Research Labs. For this tutorial, we will walk through many examples of why you need a free loan tracking spreadsheet in your Life Toolkit. To download this free tool, follow the GitHub link in the comments below. Most people have loans, so why track them? Well, borrowers need to make better decisions. Can I afford the monthly payment? How much money do I save by making extra prepayments? How many years early can I pay off the loan by making extra prepayments? And several other questions in gray here that we will answer by reviewing 6 examples using a free loan amortization spreadsheet with a download link in the video description below. Example number 1, a simple loan amortization calculator. Imagine taking out a conventional loan for $250,000. It's a 30-year fixed rate mortgage and the APR, annual percentage rate, is 6%. You may have some questions. How much will my monthly payment be? How much will it cost to borrow that money? Well, let's find out. Let's go plug the numbers into the spreadsheet. Here's the free loan amortization spreadsheet. I've started with the cells all deleted here. Usually you wouldn't start this way, but I wanted to do that to show you the error message up here. So let's get started and let's put in the loan amount of $250,000 and then the annual interest rate of 6% and the loan period of 30 years. And the number of payments, 12 per year monthly. And we'll set the first payment date at August 1st, 2022. And we'll set the extra payment period, payments per period to be $0. And bam, we get our results here. We can see that the monthly payment right down here is scheduled to be $1,498.88. And we can also see that the total interest on this 30-year fixed rate loan is $289,595. Note that the total interest that you pay on the loan, $290,000, is more than the principal. So the total cost of the loan over 30 years is $539,000. So the bank is charging you rent, effectively, $289,000 to borrow $250,000 in cash. Bankers sure make a lot off of the interest. Example number 2, extra payments to reduce the cost and duration of the loan. Oh, and extra payments are also known as early payments or prepayments to principal. Imagine paying an extra $250 per month towards principal on the prior loan that we were just looking at. What would that do? Some questions that we might ask is, how many years early would we pay off a loan by making those extra prepayments each month? And how much money do I save by making those extra prepayments in total interest that would go to the bank? Well, let's go plug the numbers in and find out. Here's the spreadsheet again, and using the same loan terms as before, $250,000 loan amount, 6% interest, 30-year fixed rate loan. We're going to enter in this extra payment period an amount. Right now, each payment down here, payment 3, 4, 5, they're all zeros. As soon as we put 250 in here and move off of it, boom, the blue box shows up, and these cells all get automatically populated with the formula. So what we've basically said is that our 30-year loan with the original loan terms gets paid off in 21 years with a savings of 9 years simply by paying $250 extra each month over the life of the loan. And the number of payments goes from 360 down to 252. That's a savings of 108 payments, 108 months. And of course, the total principal is the same. You got to pay it all off. What you're saving by prepaying off early is interest, the total interest. So originally you're going to pay $289,000 in interest, but paying that $250 extra each month cuts that cost down to $189,000 for a $99,000 savings. You save $99,000 and 9 years of payments that would otherwise go to the bank. So $250 is fantastic. Now, if we repeat the process and go to 500, do you think these values are going to double? And the answer is they're not, but they do go up. So if you double your monthly payment, we go from 30 years down to 16.42, so it's a 13.5 year savings, and it was 9 years. And the interest, 289 drops down to 143. That's like half. You save half on interest simply by paying 500 more a month. Now, your loan terms are all going to vary, and that's why you have a spreadsheet. You can plug them all in and see what a viable monthly. You have your scheduled monthly payment, roughly $1,500, and then you'd be paying 500 more on top of that. Right over here, you'd have $1,998 would be your total payment. Example number 3, should I use a windfall to prepay my loan? Imagine you just received some unexpected money. What should you do? Examples or questions. I just received a $5,000 bonus at work. Should I pay down my home loan? Or I just inherited $15,000. Should I pay down my home loan? Let's go plug the numbers in and find out. Here's the spreadsheet with the same loan terms as before, but in this case, we're not going to add an extra payment every month. We're going to do a one-time lump sum in, say, month number 4 of $5,000 because you got a bonus, and we want to see what happens. So as soon as I tab off of this, boom, our little blue box populates, and that one-time payment saves me 18 months of payments, or 1.5 years, and it saves me $23,000 in principal, or off the total cost of the loan. Now notice, the impact of that $5,000 early on in the loan is high, but if I were to go down 180 payments maybe, which is 15 years in, half the life loan, if I do $5,000 here, I'm not saving $23,000, I'm saving $7,000. And I'm not saving 1.5 years, I'm saving 0.67. Why? Because I've already paid half of the life of the loan off. I've paid the higher interest rate. So it's important, if you're going to prepay in lump sums, try to do it earlier. The earlier in the life of the loan, the bigger the impact that it has. Now let's also go model our month number 4 example where you got a inheritance of $15,000. Let's put that in here and see what happens. So that $15,000 saves 4.25 years, 51 months, and almost $63,000 in interest that it saves. Example number 4, comparing a 15-year mortgage versus various 30-year mortgages. Imagine you found the perfect home and you need to finalize your financing. And so the lender's asking you, given the $250,000 loan, you have a choice of a 15-year that has an interest rate of 4.2% or a 30-year which has a bit higher interest rate of 4.839%. So that begs some questions. How much better is a 15-year mortgage than a 30-year mortgage, the base comparison with no extra prepayments? Or how close is a 30-year mortgage paid out at the same rate as the 15-year, where you, let's say the 15-year is $2,000 a month and the 30-year is $1,000 a month, but you want to pay the base 30-year $1,000 a month, and you want to prepay an extra $1,000 a month so that you're making the same $2,000 as a 15-year mortgage. So how close is that really when you have an extra or a higher interest rate you're paying? So we're going to look at that example and see. And then how high would a 30-year mortgage monthly payment actually need to be equivalent to the 15-year loan result in the total interest paid out? So we're going to answer all those questions by plugging the numbers in. Here's the spreadsheet. Let's set the loan terms to $250,000 like before, but we're going to set the annual interest rate at 4.839%, which is an actual value I looked up online for a 30-year at this point in time. And look at our scheduled payment. It's $1,317.56. So we're going to jot that down and use it in a comparison table in a minute. Then we'll do a 15-year fixed, and it was at 4.2% interest. And we have a $1,874 monthly mortgage that's about $556 higher per month. So that's one advantage of the 30-year, is that you have a lower monthly payment, but the disadvantage is you're paying that lower monthly rate for 15 more years. Now let's assume we want to always have the ability to fall back to the safety of the 30-year fixed rate's lower monthly payment. But we also want to try and get the benefits of the 15-year. So let's reset the 30-year mortgage here. It was a 4.839 and 30-year fixed. We're back to our $1,317 monthly payment. But then let's pay an extra $556 per month. And what does that get us? That gets us our monthly payment is going to be $1,873.56, which is the same as the 15-year, pretty close, $1 or $2. But we're going to have it paid off in 16 years, not 15, so not quite as good there. And we're going to pay $109,000 in interest, which is higher than the 15-year, which I think was $87,000. But anyway, we're going to jot these numbers down and look at them in a comparison matrix. And finally, let's try to see how much higher our monthly prepayment would have to be on a 30-year fixed to be equivalent to the 15-year. So I'm going to take 556 and I'm going to guess 845, and that gets me down to about 87, that right there. That is about the amount of interest that the 15-year mortgage had. But it gets paid off in 13 years this way. We have our base $13.17 per month. That's our fallback if we need it. The lowest we have to pay the bank. But then we're paying an extra $845, and our total payment is $2,100 a month. So we're going to jot all these numbers down, and then we're going to look at them and compare them in a matrix. So here's the results tallied in a table for the 15-year versus 30-year mortgage. It's a little bit hard to read it, but let's start from left to right. This is confusing because they're all inverted values. But we have 4 loan types we're comparing, a base 30-year, a base 15-year. Neither of them have any prepayments to principal. But then because the scheduled payment is so low for a 30-year versus a 15-year, it's like 500 something bucks. If you fall in hard financial times, it might be nice to be able to fall back to this lower monthly payment. That's the purpose of these 2 options, where you have a 30-year and your payment is $1,874, matching what the 15-year is, and we want to see how close overall this approach in matching monthly payments but taking a 30-year mortgage is, or we want to see, well, how much do we actually have to prepay on the 30-year to match the 15-year as far as total interest out. So scheduled payment is going to be $1,300 for all of the 30-year flavors and $1,800 for the 15-year. Prepayment to principal, 0, 0, 556, 845. The combined payment, $1,317, nice and low. $1,874, the same for our 15-year or our matching 30-year. Or for the equivalent, we're actually having to pay a bit more for the 30-year each month to get it done and save the same amount of interest as the 15-year. So that's our 4 loans, and that's what we're doing. The loan length, if you do a 30-year and you don't prepay anything, it's 30 years. If you do a 15-year and don't prepay, it's 15 years. If you do a 30-year and you have the payments match what the 15-year would have been, you're done in 16 years. That's 1 year longer. But to do the equivalent where your interest to the bank, $87,000 on the 15-year, is the same with a 30-year loan, you're having to pay more out each month and you end up getting done earlier. You get done in 13 years instead of 15. And then the total interest to the bank. The 30-year, $224,000. The 15 years, $87,000. If you pay a 30-year at the same monthly rate, $109,000. So it's not as good. If you're just going to make payments like it's a 15-year, go with a 15-year because you're going to save more overall in interest and you're going to save 1 year of payments. But if you really want to have that fallback position and you can prepay a lot per month, well, you can do the $2,100 a month. You will save the same amount in interest and you'll get done quicker, 13 years instead of 15. And you'll have the option, if you fall on hard times, to drop back to the lower payment per month. So these green are all inverted values. It's taking the worst monthly payment, $2,100, and saying that these 2 are $288 better, and that one's $845 better. Here the loan length is saying the worst one, 30 years, this is 15 years better, this is 14 years better, and this one's 17 years better because you're paying it off in 13 years. And then the interest to the bank. The worst one is $224,000. The next one, well, they're kind of the same, is $136,000 or $137,000 better. And then this one, matching 30 years, only $114,000 better. So that's how you can run through and plug the numbers in and compare different scenarios. And everyone's loan is different. You're going to have different interest rates. You're going to have different total loan amounts, etc. So you got to go look all that information up, plug it in the spreadsheet, and figure out each scenario for yourself and your unique situation. Example number 5, manually tracking payments. In the previous examples, we tested out future scenarios with varying loan terms. But what if you want to track your new or existing mortgage and put in the actual prepayments that you made and loan terms? Well, let's do it using the free edition of the spreadsheet. Here's the spreadsheet. We're using the same loan terms as before, $250,000, 6% interest, 30-year fixed. But to manually track the payments, we follow a simple 2-step process. First, we make sure we've zeroed out the extra payments right here at $0 all the way down. And then each month as we go along from month number 1, if we paid $250, we enter it in. And as soon as we move off the cell, boom, it changes to a darker yellow. It used to have a formula Now it's just a value and the formula is gone. That's what the dark yellow is indicating. So each month you go along and do that. If I did 275 the next month, boom, everything adjusts. And I could only do 150 the next month, fine. You just keep entering it like that. If you could only do 0, you could leave the 0 in here with the formula, or I just put in a 0 and a 0. It doesn't change color, but the formula is gone. And so in this way, you track your payments as you go along. Maybe you have a big payment, $500. Also notice that you've altered the formula. So keep an original copy of the spreadsheet around. And example number 6. Everything up to this point that you've seen was done using the free edition. And I made it so the free edition will work with ample features for you for decades, no limitations of any kind. However, there's a standard edition that does provide a bit of additional functionality. And you can purchase the standard edition out on Etsy. There's a link in the video description below. And please consider purchasing a copy just to help me out if the free edition proves useful to you over the months and years. Just come back and make one-time purchase. So enough of that. Let's go walk through the 4 additional features you get in the standard edition. So here's the standard edition spreadsheet. Notice that we're using the same $250,000 loan amount, 6% interest, 30-year fixed rate, and we're prepaying $250. On the Graphs tab, this graph on the left is available in the free edition, but it's also available in standard edition. But what the standard edition has is these 2 graphs. The free edition doesn't. So the upper graph here is going to show you the comparison of payment types, the original loan totals and the loan with extra payments. So that $250 extra that we're doing a month, the principal is the same. This $250,000 is the same as this lighter green and dark green, but the principal we pay is less. Instead of $289,000, we pay $189,000. That's like $100,000 less in interest to the bank, and you can see it clearly here in this comparison. Also, down here in the lower chart, you get a monthly payment by the type of loan component. So the interest payments, in the beginning, most of your monthly payment goes to interest, but it goes down, 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 almost to 0 at the end. And in the beginning, your regularly scheduled principal is this light green. It's small, but it gets bigger and bigger and bigger. But by doing the early principal, we get this big, nice dark gray bar that we're getting principal paid faster here instead of at the tail end, and it knocks off however many years. But these are 2 nice charts that you have in addition to the one that's always there. Also on the amortization schedule on the main page, if we go back there, you'll have this little yellow box where you can type in an address, 1234 Honey Bucket Way. And if you have multiple properties, you can distinguish which property the spreadsheet's for based on having a name here. And the name should come up, yep, right down there. That's one extra little feature, but the more important one is this orange box that's not in the free edition. And it lights up when you, make the window a little bit bigger here, when you hit this drop down and say, what's my current payment date? Well, the tool gets the list of all available payment dates, which are set based on your criteria here. So let's say I'm in 5 or 6 months out. That's month number 6, payment number 6. If I click that, this all lights up and says, at month number 6, assuming that's today, so far I've paid, given all the criteria I entered here and any prepayments down here that aren't the scheduled ones. It says the total principal that's been paid is $30.92, and the scheduled principal was this piece, and the extra principal was $1,500 total. Right there, our sum is $1,500 when we get in there. And the total interest that's been paid, cumulative, $7,462. It's pulling that number. And the total cost, it's summing all the pieces up. So as of that 6th month, a half a year in, I would have paid that much, and my payoff date is set to this based on the prepayments that I've made. So that's the paid thus far, and you also have a balance remaining. I have $247,000 in principal remaining. The scheduled principal is $185,000, but the extra principal, all those $250 stacked up, would be $61,000. So together, it's still going to be $250,000. You can't get around that. If you're borrowing that, that's your principal. It's always going to be the same. The total interest remaining, $182,000. The total cost remaining, $429,000, and the number of payments remaining, $246,000. And the payoff duration, because that would be 360. So it's factored in the 108 that's out. It's 252 is the new with prepayments, total number of payments, and then 246 and 6 equals to 252. So I have a half a year in, 20 and a half years to go. And then the payoff date, that's NA. It's the same regardless. I guess I could merge the cells. But anyway, that is what you get with the standard edition. You get a nice little chart that shows where you're at. And you could do that the same thing with the free edition by manually entering values and then looking over here to see where you're at and how much more you have to go. But it's nice to have it all in one spot and take a screenshot of it, post it on your refrigerator and show your progress. And it's nice to have this label for the spreadsheet to know which property it's assigned to, and it's nice to have these extra two graphs. And even if you don't need them, if you really like the spreadsheet and you've been using it for a couple of years, go back to Etsy, hit this site, look up the Etsy link, and go purchase a copy. I would really appreciate it. Thank you. And thanks for taking the time to watch this video. And I hope this tool really serves you well and you get a lot of value out of it. I know I did with the one that shipped with Excel 95 back in 1995. I carried that thing forward for 20-something years until I made this spreadsheet. So it's really nice to have an amortization spreadsheet around that you can use and rely on. Thank you for watching, and if you found this video helpful, then please smash that like button and subscribe for more related content. Also, check out our other related videos and playlists in the boxes to the left.